Now, on this InvestTalk podcast, Steve Peasley listens to your questions.
This is Kevin calling from La Crescenta, California, kind of planning ahead for the future, thinking of establishing primary residence in a state with no state income tax.
And provides unbiased answers.
Good question, though. A good thought process, and always good to look forward. And I think there's only, 7 or 9 states that have no income tax?
InvestTalk. Over 42 million downloads and counting. Across America and around the world. Your participation makes it unique. 888-99-CHART.
At a time when investors are confronted with market volatility and a variety of challenges fueled by the uncertainty of inflation, unsettled geopolitical tensions, and economic pressures, Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. This is InvestTalk, independent thinking, shared success. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Financial President, Financial Advisor, Steve Peasley.
Good afternoon, everybody, and welcome to Invest Talk. It is Friday, July 8, 2022. I'm Steve Peasley, and I like doing this show every day. I like answering the questions, the financial questions and investment questions you have, and I hope you have them, that I'm interested in hearing them. So give me a call. I will promise to provide unbiased answers. Unbiased. We don't have an agenda. We don't owe any big houses, any loyalty. We don't have any of that. Believe it or not, there are registered investment advisors that do. The house that they put their money with has rules and regulations. So you got to be you got to ask the questions of your money manager, whoever that might be. So I don't have any hidden agendas. We are totally independent. We like it that way. But your questions drive the direction of the show, of today's podcast. So whatever you ask, as long as it's financial, we'll go with you. I mean, I'll go. It could be anything financial, insurance, 401ks, and most of the questions are stock, as we all know, stock questions. But we don't have to be. Wouldn't mind talking about other things than that. Okay, but I can tell you for sure, the situation we are faced in, the economic situation, I was thinking about that today. The economic situation, the economic environment we're in today, and I've said this before, is vastly different. And it's going to stay different for a number of years. You're going to have to get used to the new reality. That new reality and that difference is we are in a higher inflationary period and we're on a higher interest rate period. Even if the Fed stops raising rates right now, I think interest rates will stay high. I also think inflation will stay high. I don't think inflation is going to get out of control, at least not yet, but it's going to be high no matter what. It may not be as high as it is now. It may go a little higher, but I don't think we're going to have runaway inflation. I don't think that's in the cards at this point. I mean, all you have to do is look at oil. We'll talk about that. It's one of the talking points I want to discuss today in this hour. So I invite your phone calls in your questions, financial questions, 888-99-CHART. Let's get right down to the first question. Oh, we're going to go to Jacob first. Let's go to Jacob in the Bay Area. Hi, Jacob.
Hey, Steve. How you doing?
Good. Thanks for the call.
Thank you. I'm wondering what you think of Medtronic now that it's close to a 52-week low and on the low end of the PE ratio. I know medical stocks do better in a recessionary environment.
Yep.
And also just wondering if you think that Russia and Medtronic's exposure to Ireland has anything to do with its drop.
Okay. Medtronic, everybody, headquarters in Ireland. It develops implantable cardiac devices, surgical robotics, and insulin pumps, surgical tools, and other things. I like it, actually, if you want to know the truth. I like it that earnings are going to be $5.57 this year, which is a 1% drop. Let me rephrase that. It's going to be $5.81 this year, but they're already into their next year's reporting period. So for 2023, it's going to be $5.57. It's a 1% drop from 2022. But next year, 2024, it's going to go up 9%. That's $6.06. It's an $89 stock. Okay, pays a 3% yield. They have some debt, but not too bad. Management owns 1%. Mutual funds own about 46%. And mutual funds have actually been selling it off very slowly over the last year. When I say that, I mean there's less mutual funds. There was 3,911 a year ago. Now there's 3,721. And that's always a little disturbing because mutual funds drive stocks, not me and you. But it's at a very good value at this point and at support around $80 to $85. It's at $89 now. I don't know if I'd be in a big rush to buy it, but I do think it's a good value where it is. Okay, the cash flow is $6.43. So you're right, it's really close to its low 5-year PE range, and that's where I like to buy these kinds of things. And I do like the medical sphere. Good luck. I hope it works for you. Thanks for the call. I do appreciate it, Jacob. Thank you. My focus point today is based on the story behind the question, could the so-called 4% guideline rest on a flawed assumption? And that 4% guideline, we're talking about withdrawals and retirements, 4% of your assets per year, and you should not run out. So the question is it flawed? So that's going to be our main talking point today. I have other topics. The jobs report for June came out. I want to discuss that. Also, oil was up today above $100 a barrel, but it's way off its high. What will that mean? Wells Fargo says a recession is already here. They're saying it's already here. Okay. Now remember the common equation or common deduction that we are in a recession is taking 2 quarters in a row that shrink in GDP. So first quarter of this year, the GDP sank 1.6%. We're now, later on this month, we'll get the report for the second quarter of this year. If it's negative, if it shrank 2, we're in a recession. Now, there's other ways to calculate whether we're in a recession. There is no one way that, okay, that's the official definition, not necessarily. So, Wells Fargo says we're in a recession now. I want to discuss why they come to that conclusion. Those are the things we're going to talk about. But first, the market was mixed today. The Dow ended up being down 46 points, the NASDAQ up 14, and the S&P down 3. So we actually had a pretty good week. For the week, the market was up. We haven't had an up week for the market in quite some time. So is that everybody's going to ask me, and I don't really know, but have we put in the bottom? I think it's possible. I don't know if it's probable, but I think it's possible. Remember, no one knows. You know, you can ask anybody you want. No, they can give you an answer, but they don't really know. So what would the odds be that we put in the bottom? Well, bear market's 20+% down from the high. We've been there, right? We started the downturn in January. That's for the S&P 500. The growth stocks are down over 30%. But the value stocks are only down about 12 to 15%. So is that deep enough? And remember, I told you that the average bear market is 33%. That's for the S&P 500. So we don't really know, but it could be. Everybody knows that the Fed's going to raise rates, right, in the next meeting in this month sometime. So that's probably priced in. Depends on how much they raise them, right? So there'll be no trivia question today because I usually talk about the KPP Premium Newsletter and give you a little highlights of that. So that's coming up at the halfway point. We're moving into a break. It's Friday, so I will share highlights from the KPP Premium Newsletter, as I said, and that'll come at the half hour. Okay, the bottom of the half hour. My InvestTalk phone lines are open, 888-99-CHART.
Why do listener questions make InvestTalk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
I was curious if you still think aluminum has a ways to go from here.
When do I know the right time to take profits?
Should I be looking for an exit? Should I be holding here?
And listeners instinctively realize that InvestTalk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
Hey guys, love your show. I've been listening for several years now, and I've learned a lot.
Justin Klein and Steve Peasley understand what investors need and want.
I would look at it from a tax perspective. If there's no tax implications, move on, find better ways to use that money.
I'm going with the odds. I think a half position now would at least get you in it and get you watching it so you won't lose track of it.
Don't forget to call InvestTalk, 888-99-CHART. Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
Hey, Justin and Steve, this is Rob from Connecticut calling. Wondering if you have any experience or if you've advised anyone in purchasing tax liens on property and collecting interest. Wanted to see if you guys think that's a viable investing option in place of purchasing properties. I'd love to see what you think. Thanks.
Okay, tax liens on property. I have not been involved in tax liens. I have been involved in first, second, third trust deeds, which is something I assume is similar. Lien is when someone forgot to pay something, like the property tax bill, or they didn't pay off a loan, or whatever, and they put a lien on the property. So in other words, that property cannot be sold without the lien being satisfied. But if it's a lien, I guess you could call a second trustee a lien on the property, a type of lien, because that second trustee is a second mortgage. You got to pay that off before you can transfer the title or sell the property. I do like first, second, and third trustees if there's still a lot of value in the property, because you can make a pretty high interest rate. But then but the question is, in those types of situations, you have to be prepared to buy the property. You got to be prepared to pay off the first trust deed if the value of the property is not enough when it's sold to pay you as the holder of a second or a third trustee. You see, so you don't want to have a lot of debt on that property if you're in second position or third position. The person in first position gets which is the first mortgage, gets paid first when the property is sold. The second, the mortgage or lien gets paid second. So let's say it's $1 million property, it has $500,000 first trust deed. Okay, so the mortgage is $500,000, and you lent a second trustee for $200,000. So that's a total of $700,000, and the property's worth $1 million. Well, you're fine, because if they sell the property because the guy didn't pay the mortgage, and therefore the first trustee guy takes ownership of the property, the value of the property is enough to pay the first trustee and you. See, so that's how that works. So you just have to know what you're doing and be careful. That's all that is. My focus point today is based on the story behind, could the so-called 4% guideline rest on flawed assumptions? What it means is retirement. In retirement, we money managers have been using 4.5% rule that you could take that much money out of your investments and never run out of money. So they're saying, well, maybe that's flawed. And they're talking about people might spend more money at the beginning of their retirement than at the end, and they may run out if they take more than they should, and they won't last. But if you stick with the 4% rule, you should last, because statistically, as you get older and older and older, you spend less and less money. It's the stats don't lie. It just is a natural consequence. The people from 65 to 74 years old spend less than the people under 65 when they retire, and so on and so forth. If you're over 74, you spend less than the group of 65 to 74. So groups spend less over time. So is the 4% rule still applicable, or 4.5%? I would say yes. Now, the article's saying, and I don't disagree with them, that the returns going forward for the next 10 years are going to be lower than they were in the last 10 years for the investments, stock market investments, and that's probably true. But I still think the 4% rule will apply. I still think you can get 4% or more in your return. So I think it still applies. I think it will be fine. Okay, we're moving into a break. My InvestTalk phone lines are open for you, everybody. 888-99-CHART, 888-992-4278.
You've got a portfolio to grow and protect, and this is no time to lose focus. So get your finance and investment questions together and call Steve Peasley and Justin Klein. They're ready with their unbiased answers. InvestTalk, 888-99-CHART.
888-992-4278. Let's talk to Sid from North Carolina. Hi, Sid.
Hi, Steve. Good evening. Happy Friday, and thanks for taking my call.
Thank you.
I'm really enjoying every day you and Justin guiding us and helping so many people like me. So thank you so much.
Thank you.
I have SRNE in my radar for quite some time. I have those small positions, but looks like it has a lot of mixed signals, and I don't know, should I get rid of or add more? Do you have any suggestions from the technical point of view? That would be really helpful. Thank you.
Sure. This is Sorrento Therapeutics, everybody. It's a small cap, a $941 million market cap, so it's small. It hasn't made money. It's never made money, but it's going to make big money in 2023. That's the estimate. I mean, it's going to lose 94 cents a share this year. Last year, it lost $1.45. Every year before that, it lost money, except in 2017, it made 13 cents. Next year, it's supposed to make $8.42. It's a $2.75 stock. So if you look at $8.42 worth of earnings and a $2.75 stock, you can see what a cheap stock this is. The problem and why it's, Sid, why it's scary is because it's lost money almost every year. Why all of a sudden are they going to make so much money next year? Do you know the answer to that? Because that's really important. If that $8.42 they're making next year was because they sold something that was theirs, let's say they had some, Sorrento develops therapeutics in the areas of oncology, immunology, and infectious diseases. So they may have come up with something and then selling it off, and that's why they're making $8.42, but it might be just a one-time thing. That's what you worry about. Though I'll tell you this, at about $1.50 has really strong support, and it bounced from that about 3 or 4 days ago, and today is at $2.75. So it had a huge move up. So I think it's a really high risk. They have a lot of debt. Management owns 3% though, but mutual funds are not buying it. So I think if you had a good profit in it, I'd start taking it off the table. I would. Now, not that long ago, it was selling for $12, $14 a share, beginning of the year. That would be a huge move up from here. But you might just start cutting it back if you're already in a profit position, because it's very high risk. Unless that money that they're making next year is consistently high going forward. In other words, is it a recurring income? Thanks for the call, Sid. Interesting stock. Good luck with it. 888-99-CHART. So we had the June jobs report out today, and it was better than they expected. The number of jobs created in June, 372,000. They expected only 250. Remember, last month was 384,000. So it was not as strong as last month, but it was more than expected. And the unemployment rate stayed at the exact same rate as last month and what they expected, and that's 3.6%. The labor participation rate last month was 82.6. This month, 82.3. Now, that is a pretty small move down in labor participation, and I don't know if it means anything yet. If the participation goes down for the next couple of months, you got a trend going, and that's not good. Wages. So, because remember, we're worried about inflation, both services and goods inflation and wage inflation. Well, in this report, there's no wage inflation. It was up 0.4 the month before. This month, it was only up 0.3, so it's not increasing, and that was what it was expected. So it wasn't, as far as the market's concerned, it wasn't a bad report. Jobs were still pretty good, not as good as they were last month. Unemployment rate stayed pretty much the same. Labor participation rate is not too bad, and there's no inflation in numbers that we see in the hourly wages, at least for June. So you can see how that does not put a lot of pressure on the Fed to raise rates. That's what the market is looking at. What is the Fed going to do with interest rates? They've said they're going to raise them. Okay? So that's what they're going to do. We're pretty sure they're going to do it. Now, how much? Is it going to be the same as last time? More? Less? And then that's going to be all driven by what these economic numbers say by the time they meet. That's where that's going to be driven. So we'll see. We'll see. Now, oil, if you remember right, oil popped up to $124 a barrel. Then it fell all month down to high 90s. And today it was over 100 today. So it is 14% off its high. Okay, from its high. Gasoline demand is still high. Natural gas demand is even higher. So there's no softening of demand. In other words, the Fed would like to see some demand destruction. In other words, less demand, so prices will come down. And they don't see it yet. It's not coming yet. So you can see how there's a conflict here in numbers. And oil and natural gas are very, very important as far as overall inflation, right? Because everybody uses gasoline. So everybody uses oil. So we'll see. Well, wait, there'll be several more weeks of statistics before the Fed meets. We're going to take a break here. On the other side, I will dig into the excerpts from the KPP Premium Newsletter. So hang on.
How about we heat things up tonight?
How so?
Get a little fresh, add some steam, sizzle, and spice.
Wait, you're talking about going to Outback again, aren't you? Fire things up at Outback Steakhouse. For a limited time, try our bloomin' fried shrimp or get fresh with our new strawberry salad. Go big with our bone-in ribeye or the filet and grilled shrimp on the barbie. Then cool off with a cucumber crush or peanut koala. Try them all before they're gone. Let's Outback.
We seek adventures that take our breath away. And we travel with the United Explorer card. Join us and become an explorer. Then, for a limited time, you'll earn up to 70,000 bonus miles, as well as double the miles on all United purchases and on dining and hotel stays. Plus, you always get a free checked bag on every United flight. Terms apply. Visit theexplorercard.com to apply today.
Have you heard about Riskalyze? It's a brief question and answer form that you fill out online. Steve Peasley and Justin Klein will also get a copy of your responses. They can use the Riskalyze results to help you formulate a strategy that fits your investing risk tolerance. Learn more anytime and take the Riskalyze quiz at InvestTalk.com.
888-99-CHART. Let's take a live call before we start the newsletter bit. This is from Richard from Santa Clara. Hi, Richard.
Hi, Steve. Hey, I was just wondering, given this environment, how do you feel about 3M as a buy right now, given that it's come down, about 50% from its high, and given the environment, with industrials.
It's now have moved into the value side of the market. Very good value at this price. It's $128, everybody. 3M Corporation provides industrial tapes, adhesives, medical and office products, surveillance and communication products. It's going to make $11.16 next year, up 5%. It's a huge company, $73 billion. So they don't have a lot of sales growth. Okay, and it is somewhat cyclical, right? So in a downward trend of the economy, this stock will get hurt. Well, it did get hurt. It was over $200 a share. Now it's $128. And they're going to make $11, still going to increase earnings next year. Sales are flat, but that's okay, even if the sales shrink. It pays a 4.6% dividend. That dividend is totally solid, not going to go away. See, most people, and you're thinking right, okay? Just so you know, your thinking is right, Richard. You buy stocks when they're on sale, okay? Now, can this get cheaper? Sure it can, but it is on sale. This is a good bargain for 3M. So I kind of like it.
That's great.
Okay?
All right. Well, thank you very much.
I hope it works. Good luck. It will work if you be patient long enough. It will be fine. So you just buy it and put it away and say, okay, I'm going to just stick with it. You'll be fine. Okay, the KPP Premium Newsletter was finished today, and it will be distributed to subscribers tomorrow morning. So the market conditions section, there are 4 sections to the newsletter. The market conditions section is the first one. And I explained in that section it was a shortened trading week on Wall Street this week, but the holidays seemed to spark the market to the upside. We shouldn't get too excited, though, about it at this point, but it's nice. It's a really nice change. The improved market might have more to do with being oversold, okay? Oversold, sold too much and might get a little bounce, or it could have been due to the move up. The move up could have been due to the market participants thinking that the Fed may not be as aggressive as first believed. And that is as oil prices came off their highs. On Tuesday, the factory orders report for May came in much stronger than expected at 1.6% from 0.7% the month before. Core capital equipment orders were revised higher at the same time to 0.6% from 0.4%. These numbers were followed on Wednesday with the June's ISM service number that was higher than expected, but a little bit lower than the month before at 55.3%. Anything over 50% is expansion in the economy. The number is important because the U.S. is a service economy. So that's part of the market conditions sections, okay? Consumer spending and confidence has fallen recently, right? And I mentioned that as well. So remember, the consumer is the driver of the economy, right? 66% of our economy is consumer spending. So, and then they also released the weekly, I always mention the weekly unemployment claims. That's a leading economic indicator. And it was a 235,000 from 231,000 the week before. And that's that's not a high number, but it is the highest number since January. And the 4-week average has been rising slowly. So is the job market starting to weaken? That's really the question those stats kind of leave in your mind. Okay, so many experts have called for a weakened market for the summer and into the fall. We believe that this is probable. That's the probable path for the stocks in the short run. But we also believe that the Fed is late in reacting to the slowly weakening economy. Is Wall Street starting to sense that change with this week's strong pulse up in stock prices? The summer, as we have stated many times in recent newsletters, is going to be volatile. And so far, it has been true. But it is very possible that a bottom of the market is in or will be sometime this summer, or maybe early fall. Of course, there's a lot more detail in the newsletter I give you there, so And every newsletter has 2 stock ideas. Okay, in that section, I focus on a company that has become one of the world's largest consumer product manufacturer, generating more than $75 billion in annual sales. Kind of like it wasn't 3M that was called in early, but kind of like that kind of stock. That's the kind of stocks that look for value, not growth. At this point, okay, this one paid a 2.5% dividend. They have 21 different brands that produce $1 billion or more each. Kind of like that. I also recommended a company that designs a wide variety of consumer electronic devices, including smartphones, tablets, PCs, and more. Maybe you can figure that one out. We actually own that one in some of our managed companies accounts for some time. If you listen to this radio, I've owned that one for a long time in many of our managed accounts. So maybe you can guess what that one might be. And of course, the newsletter names names. So I would suggest I give you a teaser of the KP Premium newsletter every week, every Friday. Subscribers receive the full report on Saturday, every Saturday, each Saturday morning. But if you're interested in receiving it and learn more about subscribing, you can go to InvestTalk.com. InvestTalk.com with 2 T's. Let's grab another caller question from 888-99-CHART.
Hi, guys. This is Kent in Texas again. I was calling for us old guys in our 70s that are getting long in the tooth. What I want to know is what y'all recommend us as far as our spouses, like mine of over 50 years, and as far as involving individual stocks and ETFs or mutual funds. Do y'all kind of tell us to get further into the ETFs and mutual funds and out of individual stocks when we're this far down the road and way closer to the end than we are the beginning? All right, my friends, that's the question. Thanks a lot. Bye-bye.
I would say no. I see no reason to go and move away from a good, solid group of stocks when you're in your 70s, or hopefully they're a big blue chip dividend-paying stocks and you're making money on the dividends, earning money every quarter from these stocks paying you. But when you're in your 70s or older, you're looking for income normally. A lot of people looking for income. And, you can get more income with a group of great paying dividends individual stocks than you usually can get from an ETF or a mutual fund. Because the ETF and mutual fund has fees. They have annual fees that you have to pay. So that eats into your dividend return, where if you own the stock, there's no cost to own that stock. Right? There's no cost to buy and sell stocks these days. So no, I see no reason to change. As long as you have a good, solid, balanced portfolio, I don't see any reason to change to buy mutual funds and ETFs because you're older. I don't think that's a good reason to do that. And 70 is not that old. You're probably going to live to be 100. So, it's not that old. Okay? Of course, some 70-year-olds are older than other 70-year-olds, right? We know that. Depends on how healthy you are. Okay, oil back down above $100 a barrel today, but gasoline demand still high, natural gas demand is still high, and there's been no demand destruction like the Fed is hoping because of the high prices. Remember, there's an old saying: the solution for high prices is high prices, because people will stop spending that money because it's too high. Well, that's not happening with oil, natural gas, and gasoline. Wells Fargo says a recession is already here. Remember the definition of recession is 2 quarters in a row of shrinkage GDP. That's the most commonly referred to stat as to whether or not we are in a recession. And we did shrink in the first quarter, 1.6%, I think it was. And the second quarter, we won't know. The GDP report won't come out until toward the end of July, so we won't know the second quarters till then. But Goldman Sachs says, according to the National Bureau of Economic Research, who uses a broader definition of an inflation, we are in a recession. Okay? Now, I guess so. I think it feels like a recession, doesn't it? It feels like it. The stock market believes that we're in a recession because remember, the stock market goes down before any sign of a recession. It starts its downward side. And it started in January. There was no signal. Everything looked great in January, February, March. Everything looked great. Okay? It's just now starting to look not as great. Still pretty good, but not as great. Inflation is, the Fed was raising rates now, and inflation is really high. So the market is a pretty good indicator of what's going to happen in the economy. Also, the market will start to rise at the very depths of the recession. Now, if the recession is not very deep, they'll start to rise before the numbers tell you. If the recession is very deep, it'll do the same thing. We just don't know how deep the recession is going to be, and the market could give up more or not. You can't time it. Don't try to time it. It's not possible. Too many people think they can do it. It's been tested over and over and over again. There's been study after study to see if you can time the market. You can't do it. The worst thing that can happen is you try to do it and you're successful the first time. Why is that the worst thing that can happen? Because then you think you can time the market and you're going to try it again and then again and again. You're going to see how it fails every time. Okay? Most of the time. So don't try to time it. It's just not a healthy way to do it. Summer's here, everybody, and I'll bet that a lot of people are amazed how investment environment has changed, and it certainly has changed. Okay, we know that, all right? You got to be prepared for the reality of the change. The market is more volatile, and it will probably continue to have that high volatility throughout the summer. So pay attention. So I think it's worth taking a minute or two to talk about some of the benefits that KPP Financial can provide, that myself and Justin can provide for you. We're in Orange County, California, between LA and San Diego. And I will remind you that at KPP, we operate with a philosophy of independent thinking, shared success. And what that really means is we give and provide unbiased guidance. We're not beholden to anybody. Also, we practice parallel investing where we buy the same things for you as we do for ourselves at the same price, same time, same percentage. So we're on your side of the table. We want to be on your side of the table. So if you want us to take a look at your portfolio, it's free. We'll take a look at it, tell you what we think. We'll try to get an idea of how much risk you're taking and get an idea with our Riskalyze little survey that you can take, a little short question and answer period, and try to understand your risk tolerance and how much risk is involved in your portfolio and see if you're comfortable where you are. We do that for free. We do that for everybody. So we are different, everybody. We really are different than many other money managers. Try to find one who will buy the exact same thing, same price, same time as you. They're very, very far and few between. And we want to help you. We can help you, and we want to do it. So give us a call. The sooner you do that, the better off your portfolio will be, and so will be your wealth. Let's go to Bill in Northern California. Hi, Bill.
Hi, Steve. Good afternoon. My question is about my portfolio overall, or at least a large percentage of it. I received an inheritance in January, and I had been kind of slowly investing. I did some ETFs to get a larger amount of money into the market earlier in the year, and of course that's worked against me from since the market dropped value-wise. But that's more of a long-term thing. I just didn't want to have the whole thing sitting there in cash because it was quite a few $100,000, hundreds of thousands of dollars. And, so I started looking for value stocks and just gradually buying and been buying all the way up till recently. And, and then it's like, okay, well, I still have about 40% of it sitting there in cash. And I just wondered, what your philosophy on that would be as far as reinvesting methodology and timing.
Okay. Well, that's a very good question. And my answer would be you should keep doing what you're doing. Okay. Yeah. Could it go down more? Yes, it could go down more. But no one knows when. And you could maybe slow down right now and speed it up maybe in September, because the fall is usually the best time of the year for the market. The last 3 months of the year and the first 3 months of the year are historically the best 6 months of the year. So I think you should look for stocks that are value-oriented and big blue-chip dividend-paying stocks. We talked about 3M earlier call. That would be something that I would consider if I were you. And it has fallen from 200 down to 108.28, right? So it's had a really big slump. Can it go down more? Sure, it can. But, boy, it's certainly a good value. And you're going to get 4.6% dividend yield. So that's a type of stock I think you should invest in because you know they will turn around. They definitely, clearly will turn around. You just have to be patient. Don't panic. You're fine. You're doing good, Bill. You're doing the right thing. This is InvestTalk. The weekend is here, or almost here. I'm Steve Peace, and we have one goal, as you know, and that's to help you achieve financial freedom. To do that, give us a call. 888-99-CHART.
Now, each time I host the InvestTalk podcast, I have the satisfaction of taking caller questions and then breaking down the often complex dynamics involved. If you've never called, don't hold back. You can leave your InvestTalk questions on the 24/7 Anytime Listener line at 888-99-CHART.
Hi, I enjoy your show. It's great. I did call up once. I am well diversified. My call at the time was that I bought at a dip thinking that I was buying at a good time, and then the market crashed. I had bought the Apple, NVIDIA, Google, and Amazon. It's come back, and it's on the green line now, so that's good. So by the time I believe they answered the question saying there's going to be a 10-year wait. And I know you guys don't know everything, but my point is it's above the green line, and I'm wondering if I should sell. Should I sell the Amazon and the Google while it's green? That's my question. Maybe. Okay, thank you.
No. That's pretty easy. You hold on to Google, you hold on to Apple, you hold on to Amazon, you hold on to all three of those for the foreseeable future. Okay? Yeah, they've already come back down. I mean, I'm thinking about maybe adding them at this point. Haven't, but I'm thinking about it because you're never going to. Remember, Google's going to split 20-for-1 here this month coming up. Apple is doing. Look at the sales growth of these companies; they still are growing. Yeah, growth companies are not in favor. So what's going to happen is you may have a period of time where they don't perform. I remember a number of years ago where Apple, we held it for 2 or 3 years and it didn't budge. We kept it. Okay, that dead money for 2 or 3 years. And then zoomed up. So it is possible we could have that kind of environment, but I see no reason to get rid of those stocks. None. I would hold on to both Amazon and Google. Let's take another caller question, this time from a listener who called earlier from Texas, 888-99-CHART.
Hey, Steve and Justin. This is Adam from Texas. I was calling, and I hope this isn't a conflict of interest because you guys use this platform, but I'm looking to short Spotify, and I was wondering what you think. Ticker symbol is SPOT, Sierra Papa Oscar Tango. Thanks again for what you do. Bye.
Okay. And no, there's not a conflict of interest. There isn't. Spotify Technology, a Luxembourg-based company, provides music streaming, subscriptions on service to 184 countries. It's a $20 billion company. They have never made money ever. They're going to make money next year, 9 cents a share. It's a $104 stock. Now, it's fallen from $340 or so. Right, $370 down to 104. The question they're asking is it going to fall more? Well, based on valuations, it should. Remember, this is a growth stock. It's growing about 17, 18, 20% sales, and they're finally making money next year, but they have a lot of debt. Management owns 30% of the stock, so they really want to keep it going. And mutual funds own 50% of the stock. And they've been slowly buying, and they drive stock prices. I think, I wouldn't short it because they're finally going to make money and the sales growth is very strong. But if you're asking me what the value of the stock is, it's much less than $104. Let's say it would take 15, 18% and use that as a multiple of earnings. You're still talking about a $7 or $8 stock because the earnings only 9 cents. But see, the sales is still growing. It's a growth stock. Growth stocks are out of favor. So it could easily go down further. It also looks like it's trying to find support at $100. So it's a tough one to short, in my opinion, because for the last 2 or 3 months, that it's held up around $90 to $100 pretty strong. So I wouldn't short it. I just wouldn't. Even though it's fundamentally, it should be worth less than it is. Okay, let's see. I'm doing okay. I guess we're out of time. I'm Steve Peasley, and this completes another InvestTalk program, everybody. Justin Klein, I thank you for listening. And we encourage you to tell your friends and family members about us. It's a free podcast. It's free download, everybody. You can get your downloads anytime, iTunes, Google Play, and the stock we were just talking about, Spotify. And by the way, we have surpassed 43 million downloads, and we want to thank everybody who downloads our program. Please be sure to review and rate us if you downloaded at iTunes. Your positive rating raises our profile and helps us spread the word, and we appreciate that. Independent thinking, share success. This is InvestTalk. Enjoy your weekend, everybody.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial. Thank you for listening, and your comments and questions are welcome on our 24-hour listener line at 888-99-CHART.